IVM.
BQ Big Decisions, the BloombergQuint podcast that helps you make the right financial choices. Hey guys, thanks for listening in. This is BQ Big Decisions on BloombergQuint, and I'm Alex Matthew. If you're an equity investor, things are looking good right now. The equity benchmarks are hovering near record highs, and there are signs, early signs perhaps, that the broader markets could be heading higher as well. In conversations we've had on this podcast series, we've talked about the how and why of investing. We've stressed that you need to set your financial goals, identify how much you need to save, and then think of where you need to invest. Today, we're assuming you've done all of that and are now considering investing in equity. We're also assuming that you're not looking to invest in stocks directly. So, we're talking about equity mutual fund schemes. To know which equity mutual fund schemes you need to consider, you should first know the various types available to you. My guest today is going to take you through all of these, their use cases, and also his top picks in each of them. I'm joined by Gautam Kalia, the head of investment solutions at Sharekhan. Thank you so much for joining me today, Gautam.
Thank you, Alex.
Now, before we get started on the types of equity mutual fund schemes, Gautam, let's talk about why you need equity mutual fund schemes in the first place. We've spoken about this before, but I think it bears repeating. You don't buy equity mutual fund schemes for short-term objectives, right?
That's absolutely correct, Alex. We recommend at least a 3 to 5 year minimum investment time horizon before looking to invest in any equity mutual fund. Most people, they look at open-ended funds and they say, okay, I can withdraw the money anytime. But they need to keep in mind that the volatility, is not really your friend. And the best way to beat volatility is increase your investment time horizon. And that's why we suggest at least 3 to 5 years minimum.
One of the popular sayings in the equity markets is that 80% of your gains come in 20% of the time. And perhaps that's one illustration as to why you should essentially hold for the long term.
Yes, absolutely. And in fact, if you see recent market movements, the returns have started coming in even shorter periods of time.
Right.
So it becomes even more important to stay invested because you never know when that next rally is going to give you the next 20-30% returns in a matter of a week or two.
Are you also a proponent, speaking very broadly here, of saying that if the market falls dramatically, and when I'm saying markets, I'm talking about, of course, the benchmarks and now in this instance, broader markets, that is an opportunity to buy more?
Yes, I think every time the market falls, it is an opportunity. But again, we come back to the point of the topic today is where are you invested and where are you investing? Because market falling could have little to no impact on your portfolio depending on where you've invested.
Which is the perfect opportunity to segue into the conversation that we're meant to have today. And we're talking about the broad classification because in order to understand where to invest, Gautam, we need to understand the various options available. So what are the various options? And I think that SEBI, which is the market regulator, has done quite a good job in classifying these, right?
Yes, absolutely. So SEBI in October 2017 basically made it extremely clear for the industry, telling us how to classify different equity mutual fund schemes. Actually, they gave a classification for across mutual fund schemes.
Yes.
And it made it extremely clear and precise for all of us. And that is something that now reflects mostly in the names as well of all the funds. So as a first-time investor or a new investor, it is fairly easy to determine where you are putting your money. So if you're investing in, let's say, something called a top 100 fund or a large cap fund or a blue chip fund, then you know that you're investing in the top 100 companies of the market.
Right.
And that's thanks to SEBI because they said, okay, large cap funds are the top 100 companies.
Understood.
So they basically said, which part of the market are you investing in? If you're investing in large size companies, and size is determined by market capitalization,
right?
What we call as large caps, mid caps, small caps.
Sure.
So SEBI said if you are investing in the largest companies, that's called large cap.
So I think, if I'm not mistaken, this classification became necessary because there were mutual funds out there that were launching schemes that were not necessarily true to the objective that they had set for themselves, right?
Right. So, it's true to label is one parameter that we do look at. It's actually a tricky thing because it may not be intentionally deceptive.
Understood.
It may just be that you have an objective, but it's not in line with what the market is doing.
Yeah.
And it may be a little bit creative.
Sure.
And that may lead to confusion in the mind of the end investor.
Okay.
So it's just about making sure that there's greater transparency and less
ambiguity.
Less ambiguity, exactly. I think that's really the.
Let's talk about this. You mentioned large caps, and that's the one broad classification that you have. How many classifications are we talking about?
So we are talking about 10 on the equity side, and so one way to classify these funds is basis what part of the market are they investing in, and by part I mean size of companies. So
Sure.
if you invest in the largest, you're talking about large caps.
Yep.
If you're investing in the middle section, which is the mid caps, if you're investing in the smaller companies, then it's the small caps.
Okay.
If you're investing a little bit of all three, then it's a multi-cap.
Understood.
So one factor for determining where you're investing is basically the size.
So we've done 4 already. So there's large caps, mid caps, small caps, and multi caps, which invest in a combination of the above 3.
Correct. Right.
So what else is there? And we'll go into each of these and why you need them.
Sure. And then you have a separate category called large and mid cap.
Okay.
So there, SEBI has categorically said that you need to have at least 35% in large cap and 35% of the total assets in mid cap to qualify as a large and mid cap. So because you had some funds that were calling themselves large caps, but they weren't investing in the top 100, they were probably investing in the top 150 or top 200.
Right.
And because large cap definition changed from each fund house to fund house, each manufacturer, each asset management company had their own definition.
Correct.
And that's why it became important for SEBI to come out with this regulation.
An additional classification.
Exactly, saying that this is a popular segment, let's just call it large and mid cap, because some investors are okay investing in the top 200 and not restrict the fund manager to invest only in the top 100. They want the fund manager to have more choice.
Yeah.
And they don't want the fund manager to look at, let's say, small caps.
Yeah.
They want to have no exposure. So large and mid cap became a
So likely
popular
those
category.
companies that could in the future, in the next 5 years, say, become as large as some of the Nifty 50 companies today.
Exactly, So mid caps are the future, and that's why large and mid cap became important. So mid caps are defined as those funds that invest in companies who are ranked 101 to 250th.
Understood.
In terms of size.
Okay.
So it's the top 100, then 101 to 250, and then the rest are 251 onwards are small
caps. All right. So that's in terms of the market capitalization. There are other classifications. We've run through 5 now. There are 5 more to talk about. What's the 6th one?
Okay. So one is obviously on the size of the companies.
Sure.
The second is the type of companies.
Okay.
So for example, if you're looking at high dividend yielding companies, right?
Okay.
So they're stocks that have historically paid a high dividend yield.
A lot of your public sector utilities.
Exactly.
Yeah.
Exactly. So dividend yield is another strategy, right?
Sure.
So it's an investment strategy. So then the next factor to classify funds becomes investment strategy. So
in case Gautam, people are unfamiliar with this, companies of course have a method of distributing profits, which is through dividends. And while selecting stocks, and I'm not talking about mutual fund schemes here, investors generally look at stocks that either give them phenomenal returns, which is profits that is plowed back into the business, so the business grows and the stock price keeps rising. So at some point in the future, you can look at selling those shares and then yielding the benefits of holding that for a long term. Or you look at companies that regularly distribute their profits in the form of dividends, right?
Yes, exactly. And very well explained, Alex, because that is really the difference between a dividend yielding and, let's say, a growth oriented
Yes,
investment.
exactly.
So a company focuses on whether rewarding the shareholder today or rewarding the shareholder over a period of time by
Sure.
reinvesting
Sure.
the money. So yes, fantastic. So actually, dividend yield is a strategy,
Yeah.
right? Similarly, betting in situations or companies where no one else is looking at,
Okay.
or finding companies that are undervalued, that becomes another opportunity, that becomes another style of investing, because most funds invest with the style of growth at a reasonable price.
All right.
So growth is the first word. That's the operative word.
Yes.
They're looking at companies that will deliver growth.
Sure.
And that they are available today at not too expensive valuations. But then there are other styles of investment where you're looking at funds that where you look at funds that invest in companies that are completely out of favor.
Okay.
Right? Where you're investing in a contra view. So if everyone is talking about consumption, you go into something else like pharma.
Okay.
Right? So contra view is another category.
Okay.
And then you have value. So value and contra actually is clubbed under the same category because they are similar. Because value is also looking at funds, looking at stocks, funds that are looking at stocks that are not expensive right now, that show promise of growth, and the market is kind of missing that promise and not valuing it correctly today. So if they are relatively undervalued.
So maybe something that I looked at life insurance companies a while back before they, gained significantly over the last 6 months.
Yeah,
Maybe something like
sure.
that.
Yeah, exactly.
So identifying early, perhaps, trends.
Yeah. Identifying early, maybe even, out of favor, maybe in the down market, down cycle.
So what, according to you, is the risk classification of value funds and contra funds?
So all equity funds have a risk classification of at least 4. So they've provided a product label mechanism now, the regulator. So almost all equity funds have a minimum risk classification of 4 out of a scale of 1 to 5.
Right.
And then that's the introduction to the next category, which is your thematic or sectoral funds, which have a risk classification of 5,
Okay.
which has the highest risk.
Yeah.
So these are still diversified equity, but the regulator says that if it is focused on a particular sector or a particular theme, then it's not diversified enough.
Okay.
You may have 50 stocks in your portfolio,
Yeah.
But because they are aligned to a particular theme or a sector, it's not diversified enough, and hence it should carry the highest risk rating.
Because most companies in a particular sector are likely to be vulnerable to what
exactly
each of
they
their
have
peers
the sector risk.
Right.
So
for example, a banking focused fund would have the same vulnerability, say, a non-performing assets across the board, right?
Precisely, exactly.
All right. So that's a thematic or sectoral fund. There's also a focused fund.
Yeah. So focused fund, a lot of asset management companies started coming out with concentrated portfolios.
Okay.
Because what happened was, in response, theoretically speaking, 19 to 21 is the ideal diversification list of stocks that you can have to build a well diversified portfolio.
Okay.
But when you invest in a mutual fund, the number of stocks usually is upwards of 45, 50.
Sure.
In some cases goes to 75, 80 as well. And that is over diversification, which is not really helpful. So to counter that, a lot of fund houses started coming out with a focus fund strategy,
right,
which is basically a company that takes larger bets, more meaningful bets in a smaller list of companies.
Okay.
So that list is usually 20 to 30 stocks. That's usually the range in which they operate. So that is a separate category, because again, it becomes a style of investment.
Understood.
So that becomes, so one is obviously on the basis of where you're investing in terms of size. And the second is how you're investing in terms of style.
Sure.
So this focus fund becomes like a strategy.
And the last one to talk about, I think, Gautam, is the most popular because everyone wants to get into it, especially now, because we're about, say, a few days away from giving your investment proofs, and everyone wants to invest in equity-linked savings schemes, right?
Yes.
A lot of people don't understand all of the aspects of ELSS. Let's talk about this very quickly.
Sure. So ELSS is, it's always a little bit confusing.
Yeah.
Because equity linked savings scheme is actually an open-ended fund.
Yes.
Right? But you can't withdraw your money for the first 3 years.
Correct.
Right? So in that sense, it's a closed-ended fund.
Yeah.
So that's why it's a little bit confusing for the investor. So that's extremely important to know, because I've seen some portfolios where the customer has invested in an equity-linked savings scheme, but in the dividend reinvestment option.
Okay.
Right? I don't even know how that fund had the dividend reinvestment option, because that basically means that every 3 months or every 6 months, the dividend is announced, it is reinvested, and that money is locked in for 3 years.
Oh gosh.
So at the end of 3 years, if he wanted to remove his entire investment, he couldn't.
He can't.
And his investment of 1.5 lakhs, he withdrew 1.5 lakhs, but then he had 1,000 rupees and 500 rupees and 3,000 rupees as dividend, which was stuck.
Wow.
And so he had to first.
Gautam, I've heard of people doing SIPs in equity-linked savings schemes.
Oh yes.
Which is not really the most ideal way to go about it.
Actually, I disagree with you there. Yeah, okay. Because it's fantastic. It's it's so much more organized, because see, that you have to invest 1.5 lakhs, right? Okay, you've got your PF contribution, so maybe you don't have to invest 1.5, you have to invest 1.2, for example.
Okay.
So you have to invest, let's say, 1.2 lakhs, right? So you scurry around and make sure you have enough liquidity in January or February to meet the deadline.
Or you just plan well in advance.
Yeah, you just start a SIP of 10,000 rupees a month, right? And in Jan, you can show your SIP, which you started in April, and you look like this really good planner.
I guess it depends on how well organized you are.
Precisely.
And if you've planned well enough in advance, and if you've got enough set aside.
Yes.
And if the requirement for ELSS is not a lakh. Maybe if it's less than a lakh, then perhaps you can manage quite easily.
In fact, if you do a SIP, it kind of instills a discipline, rather than just looking at your bank balance in January and trying to figure out how much you can invest to claim tax.
But you shouldn't be investing in January to save tax anyway. You should be investing at the start of the year.
Yeah, either you invest in the start or through the year. So it's like paying your credit card bill, right? Because anyway, this money will come back.
Okay. All right. Well, we've talked about ELSS, but I want to talk about your picks now. And we've briefly spoken about the use cases for each of these. Very quickly, let's talk about large cap, mid cap, small cap, and multi cap. We didn't go into the details of that.
Sure.
Why would you use each of these in what situations?
Okay. So if you're just starting out as an investor, my recommendation would be to look at a multi-cap space, because you are giving enough flexibility to the fund manager to deliver. Right?
If you're a young investor.
Yes, especially if you're a young investor, multi-cap makes sense, because multi-cap obviously has exposure to smaller companies, which are riskier. Today, in current market environment, in fact, the opinion is kind of unanimous in terms of telling clients to look at increasing allocation towards mid and small caps, which basically, so if you're just starting out, I think it makes sense to invest in multi caps, because you are getting that mid and small cap exposure.
I think the thesis is very simple, Gautam. It's that you have the equity benchmarks, which is the Nifty and the Sensex, at lifetime highs near, and you have the mid cap index and the small cap index that are 20% or 22% and maybe over 35% off their lifetime highs. So you have a significant gap in that sense, right?
Exactly. But that gap, there is a camp in the market that can explain that gap really well.
Okay.
And they say that that gap will continue to exist and in fact grow.
Okay.
And they blame the largest pension funds and the largest foreign institutional investors for that, because all the big money is going into the blue chip stocks.
Oh, so there's a counter theory.
There's a counter theory to it as well. So because every time in the market, if you're buying, someone is selling it. Every time you're selling, someone at the other end is buying.
Going back to why you would use. So multi-cap, you're saying, is somebody who is getting into the market, is a young investor, has time.
Exactly.
What else? So large cap, why would you choose a large cap?
So you would choose a large cap if you are risk averse, and you just want to dip your toes into equity for the first time,
Sure.
and you just don't trust you just don't trust any of the mid or the small companies in terms
Sure.
of the way they run, corporate governance. You can blame the government if you have a extremely cynical view, and if you don't have a very high risk appetite, then it's better to stick to the largest companies. Because they stood the test of time.
Yeah.
And they may not give you fantastic returns immediately. They may take a little bit longer to give you. If you have low return expectations, then they're perfect. Some people are very happy earning 7-8% net of tax. Some people won't look at anything below 15%.
Sure.
So it depends on your mindset, and large cap funds are an integral component of everyone's portfolio. So you must invest.
Yeah.
You should have an allocation.
Correct.
There definitely.
And then mid cap and small cap, we've already taken our viewers through why they should consider looking at it, right? If you have a long-term, particularly long-term objective, and if you have the risk appetite, you must, because obviously mid cap and small cap is higher risk.
Yes, definitely. So if you want a smoother ride in your valuation, you sleep better at night, then obviously have a more biased investment towards large cap.
So let's take our listeners through your recommendations, just to maybe get them thinking about where to put their money. Let's talk about large caps first. And I believe you have 5 recommendations in each category.
Yes. So usually we have about 5, but for the more popular categories, we have 6 or 7. And for the, I would say, less popular categories, we have 3 or 4.
Okay.
And this is what we call as funds we like.
Sure.
And this is by our research team, which works independent of us. And they have their own process.
Sure.
So you could look at, from the large cap space, funds from Axis, Mirae, Nippon, which earlier was Reliance,
Sure.
ICICI Pru, Kotak, even HDFC and UTI.
Okay.
So these are some of the fund houses on the large cap space that we are looking at and we are telling our clients to invest in.
You mentioned multi-cap is something that a young investor, new investor should consider looking at. What are your top picks there?
So multi-cap, you have some really popular funds. For example, you have funds from HDFC, Nippon, Aditya Birla Sun Life, and iPru. Then you have other funds which are also there, like from Principal, from SBI, Kotak, and Canara Robeco.
Okay.
So you have some very large funds and some mid-sized funds there, just in terms of their AUM.
It's reasonably easy, dear listener, to find the fund that Gautam is talking about. The SEBI classification requires them to use certain keywords to identify the type of fund. So if you are looking for a large cap fund, you would essentially see a large cap in the header, or you would see blue chip or something like that.
Like a top 100. Yeah.
Exactly. So let's talk about your recommendations for large and mid cap now.
Sure. So on a large and mid cap space, you could look at funds from Invesco, Sundaram, Kotak, DSP, SBI, IDFC, iPru, or Principal. So
Okay.
these are places where we are looking at recommendation right now.
Okay. You want to take us through your top picks or your top categories and your recommendations instead of running through the entire list?
What I would say is it completely depends on where you are in the market.
Sure.
So for example, someone like me, I love value.
Okay.
And that's why I always focus on value style of investing. I intrinsically get it. I understand it. And, it just gives me a thrill to be looking at companies or investing places where no one else is looking. It kind of makes me feel exotic. So I think there's this psychological problem that I have that takes me towards value.
Okay.
But most people should stick to a well-diversified portfolio.
Sure.
They should steer clear if they are, let's say, not very experienced or knowledgeable in investing, to steer clear of sectoral and thematic bets because they are definitely riskier. No matter how diversified they are.
Sure.
They should look at large cap definitely and then look at a more diversified approach to investing in large caps, which is the large and mid cap and the multi cap space. And that's really where you build. And don't look at one fund, but don't look at 20.
Yeah.
You need maybe 7 to 8 funds to kind of build a well-diversified portfolio. I would not recommend you taking on more than that number. You could go on the higher side to 10, 12, but definitely not more than that, because then you just get confused, and then it kind of ends up you set up yourself for failure 2-3 years down the line when you forget why you invested in these funds in the first place.
Sure, and also there's also and there's also likely to be replication. If you're buying 10 funds, there's a situation where 3 funds might have the same, and so therefore you're paying unnecessarily.
You're putting in 10 lakhs in one fund or 10 lakhs in 5 funds. You're paying the same amount, right? More or less. Yeah, more or less. I mean, depending on the size of the fund. But the real problem that I see in most investors is when you have too many funds, you get confused yourself. Yeah. And then you're not able to take clear decisions. So if you have 2 funds or 3 funds for your large cap allocation, I think that's more than enough. You don't need more than that. Okay. I'm quite comfortable personally to invest just having allocation to just one fund across categories and cover maybe 5 or 6 categories in my portfolio.
For all my listeners who are scrambling right now to cover their bases in terms of their tax investments, would you be able to give us your recommendations for ELSS?
Yeah, sure. For ELSS, definitely. So you could look at funds from Mirae, Axis, Invesco, Aditya Birla Sun Life, Kotak, BNP Paribas, DSP, IPRU. So these are basically funds from funds that we like, and these are the ones that we are telling our clients to look at right now.
All right. So I think that broadly covers this conversation that we've had on which equity mutual fund scheme to go for, the various classifications, and of course, some of the recommendations that Gautam has within a couple of these categories. It's been an absolute pleasure speaking to you, Gautam, on this topic.
Thank you, Alex. Thanks for having me here.
And it's been an absolute pleasure speaking to you as well, dear listener. Thank you so much for joining in on this BQ Big Decisions conversation. If you'd like to hear more in this space, you can check out our playlist on any one of our podcast applications, or you can go to the website and search for BQ Big Decisions. That's all for this podcast, but watch this space for more. This is Alex Matthews signing off. Have a great weekend.
If you enjoyed Big Decisions, check out some other podcasts on the IVM Podcast Network. You can check out Paisa Vaisa, hosted by Anupam Gupta, Advertising is Dead, hosted by Varun Dugirala, the Ronnie Screwwala podcast, hosted by Ronnie Screwwala, or Cyrus Says, hosted by Cyrus Procha. These shows are available on the IVM Podcast website, app, or wherever you get your podcasts from.
Janice, what do you think couples did before TV was invented?
I don't know, go for walks on the beach, long drives, fancy dinners, have more sex maybe?
But what did we do when we decided to move in together? We debated between the Chromecast and the Fire Stick.
We gave up on sleeping early so we could stay up watching true crime shows.
We got ourselves 3 cat babies.
And basically became the cutest couch potatoes around.
Okay then.
In case you guys still haven't got it, we are a TV crazy, Netflix loving, binge watching Mr. and Mrs.
I'm Anirudh Kuha.
I'm Janice Sequeira.
And if like us, you snort TV for breakfast, lunch and dinner, this is the podcast for you.
Tune in every Thursday on the IVM Podcast app or wherever it is that you get your podcast from. This is
Mr.
and Mrs.
Binge Watch.
Filter coffee is a fascinating beverage. You need to pick the right beans, blend them in the right proportion, roast them to perfection, and slow brew at the right temperature to get the perfect cup. Which is exactly like great conversations as well. You need to track down the most interesting minds, get them into their zone, and settle down for an unhurried, unscripted chat. And coffee for me is always, always, always best enjoyed with friends. I'm Karthik Nagarajan, and do share my table as I meet some of the most interesting people I know and sit them down for a strong cup of coffee and an even stronger conversation. Join me every Wednesday for a freshly brewed episode. This is not frappe. This is the Filter Coffee Podcast.